to the Stockout. This is your show at FreightWaves for all things related to the consumer packaged goods industry, the CPG industry. I am your host, Mike Baudendistel, head of intermodal solutions here at FreightWaves, and this is the show at FreightWaves where we set aside about 25 minutes to talk about the CPG space. And today we'll be talking to Guillermo Garcia, co-founder and CEO of SmartHop. That's a fleet management software company that specializes in supporting small fleets. And I'll also go through what I think were the main takeaways from last week's earnings reports on the retailers. Walmart and Target reported. I think there's always read-throughs, for the CPG industry as far as what those companies say. Walmart being about a 20% customer for the CPG industry. So before we do those things, do want to make sure everyone's signed up for the Stockout newsletter. You can do that at www.freightwaves.com/the Stockout. And at this point, it doesn't really matter whether you sign up for the Stockout there or point of sale. We're going to be merging the two as of September 1st. I'm going to be joining Grace Sharkey, and we're going to be combining two shows and two newsletters into one, focusing on retail and CPG in one. And I think this show is going to be good practice for that, just because I'll be focusing in on what the retailers said last week and what that means for the CPG companies. And so went through the earnings for Walmart and Target. Not going to be talking about it the way a stock analyst would be talking about it. I spent enough time doing that job the last 13 years or so. But want to bring up the Walmart stock chart, which I think is kind of interesting. So you see how this is a 5-year stock chart with Walmart in black, Target in blue. You see them trends kind of similarly for the most part up until about, let's call it the second quarter of last year, where both of those stocks dropped sharply. Looks like it was in about May. I think that was when the companies guided, down and said they have way too much inventory. Both of the companies did. That's when imports started dropping. And since then, Walmart has fully recovered. Walmart share price fully recovered, and more, up to 157.85 there, while Target's continued to go down. A lot of reasons for that. I think the biggest reason is that Target, their demographics is too close to Amazon, too close to maybe Costco, and Walmart's a little bit more insulated. Walmart is more geared towards consumables in the grocery space, which now make up more than half of its sales, even if it's less than half of their profitability. So really seen a big divergence there, and also had an interesting chart along similar lines that we have from Sonar. So this is data that's currently in QA, so the Sonar customers can't quite pull that up yet, but this has gotten some attention from those in the financial community. A lot of the hedge funds try to look at alternate sources of data that is not necessarily priced into the share price. And I think truck visits to retailers would constitute as one of those sources. You see Walmart in orange or green. Walmart is in green there, and Target is in blue. Those are trucks that visit those businesses. Not a perfect data set because, of course, Walmart has one of the biggest private fleets. I believe this is primarily for hire carriers, but you do see a much bigger drop off for Target. Less purchasing of discretionary general merchandise type items. So in going through the earnings reports last week, really have three main takeaways that I thought were incremental to what the companies had talked about before, if we're looking at it from the perspective of the CPG companies. And the first takeaway is I thought that the Walmart's comments that the consumer is holding up better than they had expected at the beginning of the quarter was something that was incremental. And I think a lot of that has to do with, now we're starting to see in some of the macro data that people's incomes are growing a little bit faster than the rate of inflation, the past 2 months. And that ended a streak of about 24 months when inflation was outpacing the pace of wage growth. So consumers, I think, are feeling maybe just a little bit better. And what that means for CPG companies, most of these CPG companies have seen elasticities stay pretty low, and would expect those to remain, fairly low. Let's say no worse than historical averages. So I thought that was a positive, read through for CPG. The consumers holding up a little bit better than expected. There was also some discussion on supplier prices on the call. We have heard in previous quarters Walmart saying that dry grocery prices have to come down. their language was a little bit more aggressive on this latest call. Someone asked them, one of the analysts asked them about promotional activity, because that's a big bear thesis in the CPG industry, that they're going to have so many promotions that they won't be able to see margin improvement. And Walmart said basically that promotions is kind of the easy way out. What they prefer is to work with the CPG companies, the suppliers, to take freight, have the lower price on the shelves reflect the fact there's been lower freight costs, that there's been lower commodity costs in a lot of cases. And it sounds like they're going to be more aggressive, with the CPG companies maybe getting some of those prices down. We have seen the dry grocery prices stay much higher than the fresh grocery prices. When you look at things like the CPI data for food. And then also there was a lot of discussion on in stock. Target specifically talking about this in stock every time concept. They're trying to do more with e-commerce and pickup and delivery. They want to give you your Starbucks while you drive up and get your order at the same time, but they want to have it sort of in stock every time is sort of the line they're using. And I think that means for the CPG companies, if they weren't already being aggressive with on time and full fees, holding the carriers and shippers accountable for that they're going to hold the CPG companies really accountable for the on time and full. So service seems to be of greater importance than it ever has when dealing with these big shippers. So those were kind of the three big takeaways from the retail earnings call. Consumer holding up well, Walmart getting maybe more aggressive on price, and then it really has to be in stock sort of every time to play. So with that as a little bit of an overview, I want to bring in today's guest. It's Guillermo Garcia, co-founder and CEO of SmartHop. He's joined us on previous discussions on FreightWaves TV. Thank you for joining me on the Stockout.
Hey, Mike.
So why don't we start off with why don't you give us a little bit of an overview of SmartHop for those who aren't familiar?
Yeah, so SmartHop is a platform that enables those very small trucking companies in the US manage their operations and perform with better capabilities than the leading carriers. And what we want is to pretty much level the playing ground so those that have their fleets very small, probably don't have the relationships that the mega carriers have with shippers and brokers, that they can operate with the same level, if not higher level, and have the ability to move and have those opportunities that the big players have.
So how do you go about doing that? And maybe to start, like, what are some of the unique challenges that without a platform like that, or just a very small carrier would have because they don't have the scale of a large fleet?
First thing to understand about SMBs in the trucking world in the US is you don't have contracts. You typically have a very transactional driven relationship with your customers, either a shipper or a broker. You're on a load to load basis. So first thing, and one of the things that we do best is helping them automate their decision-making process when using your assets, booking your loads, managing the execution of that load. And that helps your relationship with either the broker or the shipper, whoever you're hauling for. But also we understand that for them to be able to be competitive, bottom line is really important as well. And so if you have just a handful of trucks in your fleet, how can you compete if your bottom line, you're paying retail rates in fuel, if you're paying high prices with your factory? And so we're helping them reduce the cost of operation. So the pressure that they would have typically that makes them have to negotiate and be obsessed about negotiating their rates lowers. And so they have an ability now to build a relationship and to make the right decisions across the journey of their trucks.
Yeah, so a few different things there. So really, you sort of list a few different things, and it's I guess what has stood out in some of our data has just been the spread between the spot rates, which is where a lot of these small fleets play in, and the contract rates, which have stayed more elevated. We have a sonar chart that to that effect. So the white line is van contract rates excluding fuel, so just the line haul, and then the orange we have spot rates with an algorithm to remove fuel to put those on an apples to apples basis, and you see, the spot rates have been lower than contract rates for some time now, almost beginning of 2022. Maybe they've stabilized a little bit there, and how would you describe that when you see the spot rates that have that degree of spread, and maybe is there evidence that we're at a bottom with spot rates, or kind of what are you seeing in the marketplace there?
So trucking is a very cyclical industry. It goes up, it goes down, but also spot versus contracted. Some quarters, spot will outpace the contract and then will go down. The important piece to understand here is those that mainly live in the spot market, which means you don't have a contract, you're very vulnerable, and it's very volatile because you're always searching for a load, not a contract, not a long term. It's just a couple of days that you can secure when you think about spot market rates. And the other thing to consider is small trucking companies typically, and I don't like to generalize, but typically you're not provisioning for those downturn moments of the industry and also the rates. So what we've seen is the greatest combination is to have some sort of contract and spot market at the same time. 100% spot market carrier or 100% dedicated carrier, it's not necessarily the best or the maximum outcome that you can have to become a healthy trucking company. Navigating between both is where it becomes healthy as a business. But the difficulty there is how to navigate that and how to have those relationships where your assets shift from one place to the other, and you fill the gaps either with contract dedicated lanes and also spot market rates.
Yeah, it's almost like a stock portfolio. You want to have some bonds and some stocks. You don't want to have all stocks. It's too volatile. I mean, a lot of these small fleets, maybe they have a really good sort of head haul rate. Let's say from, just to use a lane, Chicago to Des Moines, but then they have trouble finding a load in Des Moines to get them back to Chicago. Rely on a broker, pays a really low rate. How can they use a tool like yours to maybe get them back to Chicago at a better rate?
Yeah, the important piece there and change in paradigm for us is we don't typically think about head hauls or back hauls. Yes, if you have a truck that goes and comes back, yes, that haul and front haul and back haul is pretty much how you need to think. But at the end of the day, if you have a contract, if you have a dedicated lane, the head haul could be the one that you are trying to fill with the spot market. So we think in kind of like loopy trips where our technology is helping bringing those contracts, bringing that priority that your fleet has with that relationship that you built. And so we take it kind of like in layers. Our technology is saying, well, if you have this contract, if you have to perform, and also if you need to execute on this contract, then from that moment on, then starts to match and think about cross network. And cross network could be other dedicated lanes, other contracts, but also spot market. So it's a combination of contract and spot market. And the other thing that we've change and help our customers change is not think about just RPM, rate per mile, right? Because at the end of the day, the important piece for a business is profits, is that profitability to bring at the end of the month, the quarter, or the period that you're looking at. And so you can take a low rate from point A to point B just to get to that load that will make up for that loss or for that low rate. But at the end of the day, the sum of all the loads that you're doing in that period, it's what truly matters. And that's where we do really good, where our technology does really good for the ops people in that carrier to understand what's the best decision at any given case and any given time.
Okay, so it's all about kind of load selection, picking the loads that'll get you into a market where you're also going to be get loaded, and maybe that means you go to a few different cities and not just sort of go back and forth in some cases. So that's interesting. For a small fleet that is, you say you don't want to be overly reliant on the spot market, that makes a lot of sense. If a fleet is overly reliant on the spot market, how can they start to make that transition where they're a little bit more balanced between the contract and spot market, and how do they sort of carve out a niche with some contractual customers?
The first thing that we always advise to our customers is one, understanding that trucking is a commodity. Quality and relationships really matter, right? I mean, your truck, there's millions of others that have your same truck and are not offering something to either brokers or shippers. So what we say to our customers is use the data, follow the suggestions that our technology is given to you, to your operations people, but build relationships. Because even if it's through our technology that we allow digital bidding and booking through our technology, those brokers or shippers that know you will typically pay more, will typically be more open of bending the bar more for you than just a one-off type of carrier. So that specific load, if our technology is suggesting that you should do it for a couple of $100 more, that broker or that shipper will, if the relationship is there, if the quality of your service is there, you will typically see a much better outcome. And $100 here, $200 in the next load, if you start adding that up, that's what's going to separate you from the rest of the pack. And we can't control the market. And we say this every day to our customers. We can't control the market. What we can do is to help you navigate the wave and be on top of that wave. And if you're making the right decisions, if you're making sure that the relationship and the quality of your service is there, you're going to have a good outcome.
Yeah, that makes a lot of sense. So the relationship somewhat dependent on, this carrier's given shipper good service in the past, therefore, they're kind of get to be a kind of a preferred carrier. I mean, I assume sort of define good service as sort of showing up on time, getting to where you're going on time. If there's some traffic jam and you can't do that, let them know ahead of time, or any other, sort of best practices that fleets should employ to deliver good service.
Well, one of the things that I think it hits really hard to brokers and shippers is cancellations. And it goes both ways. It goes the carrier not canceling the appointment or going to pick up. If you committed that you are going to pick up and deliver a load for a broker or a shipper, follow your promise and don't jeopardize that relationship, because just minutes after you booked that load, another broker, another shipper called, or you saw it on a platform just for maybe a little bit of an extra money in that. So cancellations, and I tell you that it goes both ways, because one of the things that hurts a lot to every carrier, and specifically the customers that we have that mainly live on the spot market, is when a broker does the same, right? I mean, they found someone that was willing to do the load for just a couple of dollars less, and they will just call and say, well, I'm sorry, something happened and I need to take you off that load. So as you said, picking up on time, having that quality when you execute is really important. But in that relationship building, if you commit to a broker or to a shipper, just make sure that you do, because that will put marks on you, and brokers would want, as always, if you're a broker, and think about if you're a broker and there's primary VIP type of shipper, call it, I don't know, Coca-Cola, you don't want to be giving those loads to just any carrier that call on that load. And so you are putting your name to your customer, and so you're relying on that carrier to perform well if they're going to maintain that business with that shipper. So again, it goes both ways, but being trucking, the commodity that it is, it is all about the service that you can provide, and it starts with making the right decisions, but it follows with you like really executing the way that you should.
Yeah, definitely. I also want to ask you about, I mean, one of the sort of scale advantages that the large fleets have over the small fleets is fuel buying. Maybe you can buy at rack minus a certain number of cents. If you're a large enough carrier, small fleets can't do that. How do you mitigate some of that scale advantage on fuel?
When you have scale, and it is all, I mean, the game of scale is about that, right? I mean, you have leverage to negotiate, and you're not getting in fuel specifically, you're not getting a discount on retail. You're talking about cost plus. So the savings that a mega or large fleet is getting in fuel is astronomical, if you compare it to the 5, 10 truck fleets, right? And so if you're thinking about a cost structure line item that weighs 27% of your cost structure, which is fuel, every cent that you save, it is really important. And again, brokers will say, well, but truckers are always battling for extra 50 here, extra 100 there. Yeah, but their cost structure requires them. I mean, they don't have any other option. So what we've done is we've aggregated, but also we have negotiated in volume, so that those that behave in the way that they need to behave, those that are really doing good and want to do good, have access to the same that the 1,000, 2,000 fleet truck has. And so what we've enabled is an opportunity for them to have the cost structure at the level as the big fleets, and then it's up to them to keep that as part of the benefits of working with SmartHop. And I'll tell you the truth: when you give the opportunity to a very small trucking company, probably is a mom and pop, it's owned by a family, or just a couple of friends that are working really hard under one authority, the level of service, when you give them the opportunity, I was one of them not long ago. When you give them the opportunity, the level of service is such higher than just 1,000 truck fleet, that I'm sure that any broker, any shipper would want to work with. You just need to give them the opportunity to do good and have the cost of operations that they need.
Yeah, that's really critical. I think that's what small carriers have to do is just really provide that important service, and it's getting to be more critical. It seems like the service levels. Real quick, have you seen an uptick in bankruptcies with among small fleets? I mean, it seems like it's been a tough environment for the last year and a half.
Yeah, for small fleets, they're dependent on day-to-day rates, and we've seen, unfortunately, people not being able to make it just because either they did not prepare for downtrends. Again, trucking is cyclical, so when you're doing really good, you better save money because the downtrend is going to come at some point or other, and most of small trucking companies typically don't plan that ahead. And so yes, we've seen, unfortunately, people leaving the industry just because they can't handle the cost of operations.
Hmm. Yeah, sorry to hear that, but not unexpected, I guess, based on what's happened in the market. Thanks for joining me. And how can people reach out to you and learn more about SmartHop?
Yeah, they can go to our website, smarthop.com, and reach us through the website or by phone.
Great. Well, thanks very much, and I hope everyone has a great day.